Hello guys, welcome back to another lovely trading video. In this one, we're going to be showing you how you can be risk managed when trading, how to kind of find your stops, and just how to manage your trades in general. Now we'll go through go over a few types of ways you can do this, because people have preferences and they may try and find different ways to kind of manage their risk. And again, there are going to be more ways that we go through in this video, but I'm just going to be going through kind of the ways I personally look to manage my own risk, and that may help you if you are struggling on how to manage your risk, or you just want some other ideas on how else you can manage your risks. Now there's a few ways I look to. So firstly, obviously you need to know where your entry is. So for example, we're going to go through Facebook as an example, or Meta, whatever you decide to call it, on as our first trade. So with my strategy, I know I'm going to be looking to get long Facebook at around $300 to around $295. So me knowing that, I know my average cost is going to be around $297.50. So what I can do is kind of realize that, and then I can start saying what's my most likely, or what is my upside to this trade. And I know I'm going to be trading to statistical mean. So in this case, the closest statistical mean I have is around $335. So we can see with that, I've got around a 12.5% upside. So this is one way you can manage risk. You see what is your kind of upside on the trade. I know I got 12.5%. So then I can work out kind of stops by saying, how much risk to reward do I want this trade to be? Do I want it as a 1-to-1, a 2-to-1, 1-to-3, 1-to-4, 1-to-5, so on, so on, so on. So this is one way you can kind of easily calculate it. You find out your what your upside is on the trade, and then you could work out your stops by that. And so how do you do that? All you really need to do is you kind of draw it the other way. If we know we got 12.5% upside, if we want a 1-to-1 trade, then we know we want a stop around $260. Obviously, I mean, if you got very high probability setup, then 1-to-1 can work well, but sometimes it makes more sense to kind of do something at least kind of like a 2-to-1, or at least a 1.5-to-1. So for something like that, again, we could say, okay, well, we'll have a stop at say 6%, and we've got around a 2-to-1 risk to reward on this trade. So then I can say, okay, we'll have a stop around $280 or $279. So that's really one quick and easy way you can look to manage risk, by just finding what your upside is, and then finding an amount of it. So again, 1-to-1, 1-to-2, whatever you do, and you can kind of find your stops that way. Now, what are some other ways you can find your stops? Well, kind of a very easy way, and a way a lot of traders do, and this would depend kind of more on how you finding your entries. For example, if we're looking to get long at $295 to $300, you'll then maybe try and find that next kind of price point below where you think is the next level of support. For example, you might see this area here, kind of 275, 277 as a level of support. So you may say, okay, I want a stop if we kind of break that level. So you could be saying, 272, or you want that psychological level 270 in there, something like 269. Then if you know that's where you kind of want your stop to be, you then have to justify, then is the trade going to be worth it? For example, if we're going to have our stop at around 268, we know, okay, we're taking 10% risk on that, or around 9.5% risk on that. We know in our case, at least, we're looking for 12.5% upside. So we could justify this trade, we're making about a 1 to 1.3 or so percent return on that. So that is something we could consider a trade. But obviously then you're going to miss a lot of trades kind of doing it this way, just because sometimes you're going to find out, half your trades don't actually make sense trading if you're kind of calculating risk in that way. But either way, again, you can kind of figure out stops if you prefer doing it like that, by kind of just going to that next level of support. Facebook probably is not the best example for that, because there isn't really much support going below it. But that's again one way you can do it. And we'll actually go to Starbucks, because I think that's an example for it. Yeah, because we're at 52-week lows. When you're at something like Starbucks or stocks where you're at 52-week lows, obviously then you can't really go to that next level of support unless you maybe go to like a 3-year chart, or a max frame chart. But that's when, again, that other strategy can be better. For example, if we're looking to get long here, We know our upside, my final target. If you haven't seen it, we did do a Starbucks analysis video before this. We see our upside is around 14%, or to 14 to 15%. So again, if we got no kind of levels of support below here, one way you can work this out is, again, the same kind of way we talked about before, is getting a 1-to-1 risk to reward. For example, have a stop around $82. You can have a 2-to-1, so have a stop around 7%. At around $90. So again, that is one way, and it will probably be the key way you're looking to do stops if you're kind of at these 52 weeks lows, or if you're at 52-week highs and you're looking to get short. They're probably going to be the easier way to place your stops. So really, they're the two main ways I look to focus on placing stops. So they're really going to be the only two I'm going to go through. One way that we will go through very quickly, but not something I personally do, but I know some people do use this as a way to stops, and it's by looking at the option chain. And why do we want to look at the option chain? Because you can see how much option traders and kind of market makers are expecting price to move. For example, you can see on Starbucks by the 25th of Feb, they're pricing in around a $10 move. So if you're looking at this, you can say, okay, what is my upside? So again, if we're getting long here, and your profit target is around $110, you can see your upside is $14. Market makers are expecting a price of around $10, so you could always have your stop around $11. And again, then you're still getting that bit above a 1-to-1 risk to reward. But again, as I said, it's not something I personally do. I just know some people like using the option chains as a way to be filtering out, or kind of providing you a way to find stops. But either way, that was kind of just a quick summary and kind of a quick guide on how you can be finding stops and risk manage your trades. So I hope that gives you some insight into on how to risk manage your trades. And that's it. Peace.
I go dumb for that money, dumb for that